This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore.
So now we're in the rhythm of 1 week guest, 1 week us. So we pretty much have that figured out.
Yeah. Today was a good episode. We have this intention, and we often don't do it because we probably scramble to prepare for the episodes where it's just us and end up just talking about whatever was on the top of our minds. But our intention is to have, and I've said this before, so sorry if I sound like a broken record. Our intention is to have a main topic that we go over, and then we'll talk about a couple articles too. But anyway, today we did that. We talked about safe savings rates, which is some really interesting financial planning research.
It's also good to dig into some planning stuff and a little more chilled on the factor side, although we did talk about factors and...
Can't not talk about it.
I know, but this is really important for people financially interested and planning for the long term. There's some really interesting data on the safe savings rate.
And we also addressed our frequent mentions of dimensional. So some people will be happy to hear what we have to say about that, I think.
Yeah, we appreciate the feedback. Anyways, have a listen.
Welcome to episode 34 of the Rational Reminder Podcast. We have a main topic that we want to go through today, which is safe savings rates, which is a really interesting topic that we think you'll find informative, I guess.
Yeah, most people are aware of safe withdrawal rates. This is different. This is the other side of the coin.
It's both sides of the coin. I think that's the
key
thing. Yeah. So it's like the 4% rule is how much you can spend from a portfolio of X amount once you have retired. But the safe savings rate looks at the full life cycle. So instead of just looking at once you have a portfolio and you're retired, how much can you spend? It looks at how much do you need to save for 30 years such that you can spend a desired percentage of your income for the following 30 years.
But we'll get to that.
Yeah. We have a couple things we want to go through before we get there.
So we had a bit of feedback this week from someone that feels that we're talking too much about dimensional fund advisors.
And it's not the first time this has come up. So we thought we needed to address it. I guess the most important thing to keep in mind from that perspective is that this podcast was put together and designed for primarily our own clients. And to that audience, dimensional fund advisors is highly relevant.
Right. But now the audience has grown beyond just our clients. So I think it's a reasonable piece of feedback.
Yeah. And I mean, the thing with dimensional is that if we were talking about Vanguard or iShares all the time, nobody would have this feedback. I don't think.
Because everyone has access to it?
That's my guess, yeah. But with dimensional, all of a sudden it's this thing that you can't just go and buy. You have to work through a firm like ours. So I get it. If someone does not have a financial advisor who is using dimensional funds, then of course you feel, I guess, excluded, or I get how it wouldn't be a nice thing to hear about often if you can't access it.
So as an alternative, you've been building another model that we can use to talk about, right?
Yeah. I mean, we're not going to stop talking about factor investing because that's pretty core to our beliefs. So we can't change that just because people don't like hearing about dimensional. But what we can do and what we've done is design a set of ETF model portfolios that employ as much as possible the factor investing philosophy. Now, I mean, there are tons of factor funds out there now, but we've designed some that use the same principles that dimensional uses in their products. So going forward, our intention is to de-emphasize talking about dimensional funds and instead talk about the Rational Reminder model ETF portfolios.
And talk about the evidence around this, because basically dimensional uses evidence. So we're going to stick to the evidence side of this.
Yeah. So we're getting away from the product, moving more toward the ideas, but we've given ourselves an alternative product that we can talk about without stopping talking about the factors that we believe in. So we think this is going to be better for the overall audience. Now, I guess the thing to keep in mind is that the podcast was still built for our clients, and we're not taking funding from advertisers or anything like that. So our primary audience is still our clients. We're going to do our best not to alienate non-client listeners, and we're doing that by talking about our new model ETF portfolios, which we'll launch in a future episode.
I've always found it interesting how dimensional is such a polarizing character in the industry.
Because you're basically saying these products are great, but you can only access them if you pay our fees.
Yeah, it's the access side of it, I think.
For sure.
And that really alienates people who want to have a broad number of suppliers in their offering.
Anyway, so we're mostly done talking about dimensional, but not completely done just because it is still highly relevant to our clients. But as much as possible, we're going to talk about our ETF model portfolios that have the factor tilts. And again, we're going to talk in more detail about how we design those in 2 weeks' time.
So the world's exploding with asset allocation ETFs.
Yeah.
Which I think is a great thing.
We just did a YouTube video on them. And right after it launched, or maybe it was a couple of days before it launched, BMO also came out with their own.
Three, I believe, 60, 40, 40, 60, and 80, 20, one decision ETFs.
So now we've got iShares, Vanguard.
Vanguard's got the full suite.
Well, they've got 20/80 all the way up to 100% equity, 20 fixed income, 80 equity. Horizons has had their total return balanced ETFs for a while now. Now we've got BMO in the mix too. So it's interesting. Probably a good thing for investors. It would probably be a better thing if only one company had made them, because then it makes it easier to choose. I think that now there will be more.
It's a lot better to choose the asset allocation as opposed to individual funds. Because we all know about the behavior around individual funds.
I know, but now we have this problem of people, if you don't have the context to think about which one is better, and they might have tracking error because they are all using slightly different methodologies. So all of a sudden, the BMO 80/20 fund does better than the Vanguard one. Do you think people will be wanting to switch? Wouldn't be surprised.
Maybe. But this has great rates. I mean, the balance is very similar between them all.
Yeah.
They're all solid companies. I think this is great for investors.
Oh, of course it's great for investors. I haven't dug into the BMO ones yet, but the Vanguard and iShares we dug into pretty deep when we did the recent YouTube video. And I think just from what I observe online, people seem to be getting hung up on the asset allocation ETFs in terms of you should only buy this in your RSP, or you should never buy this in your taxable account, or like, do these make sense in the TFSA? And people are getting all caught up in that as opposed to just...
But it's pretty small potatoes you're talking about.
Yeah. I mean, the problem in the registered accounts is foreign withholding tax, but we ran the numbers on that for the 80/20 Vanguard and iShares, and you're looking at about 20 basis points of unrecoverable foreign withholding tax in that account. Now, how could you do better, which is the only reason this matters? If you go out and buy US listed ETFs for Canadian and international stocks, you can get your unrecoverable foreign withholding tax down for the 80/20 to maybe 5 basis points. But then you got to
bear to manage the asset allocation and the rebalancing. Well, so that's the trade-off.
And the currency, you've got a bit of a cost of conversion. So you might save 15 basis points by going US listed, but yeah, you're adding complexity, you're adding mental overhead, and depending on how you do the foreign exchange, you're adding potentially significant costs. But in either case, you're adding complexity. And then in the taxable accounts, I've seen people getting caught up about this too, where there's this thought that, well, you shouldn't buy these in your taxable account because they are using just regular total market bond funds. And because we've been through this interest rate environment where rates have been coming down for such a long time, a lot of bonds have gone up in price.
Premium bonds.
Exactly. So you've got this issue of premium bonds. Now, premium bonds are relatively tax inefficient compared to, say, a par bond or a discount bond or a GIC. But we ran the numbers on that too. And with where things are at now, I think it was 14 basis points of tax inefficiency, I guess you'd call it, for holding the premium bonds as opposed to par bonds or GICs.
Well, that's a temporary phenomenon.
Well, that's the thing. You look at the chart over time, and the problem is when you have coupons that are much higher than your yield to maturity. 3 or 4 years ago, there was a big gap. That gap has been narrowing as rates have come up. But I mean, you got to think about it. Even if rates stayed flat and bonds are just being issued at par, the premium bond issue still goes away over time. Yep. The only time this is a major issue is when we have a long period of falling rates, which structurally can't have. Well, it's unlikely that we would have that again over the next 30 years like we had the past 30 years. So
speaking of BlackRock and Vanguard, I saw an article this morning in the Financial Times. I don't know if you've seen this yet, showing that BlackRock and Vanguard pulled in 57% of net global long-term fund flows last year.
It's unreal.
Mind-boggling number. And get this, I didn't realize this number. There's 95,000 funds worldwide in the database from 4,000 different companies. And this phenomenon of going towards the passive is really largely driven in the US. They have a little table at the bottom. And it looked like Canada still has net inflows into active, you can believe it, whereas passive to active in the US is 5-to-1 ratio. It's unbelievable how the US is leading on this. I don't know what it is about that marketplace, if it's awareness, if it's the Jack Bogle Vanguard phenomenon.
Well, that's what Rick Ferry talked about that when we spoke with him. He talked about, well, it's the Vanguard-effect, which is well known, but the way he positioned what, I don't know if this was during the episode or afterwards, but the way that he positioned it was fascinating to me, where Vanguard has an incentive to spread the message of low-cost index investing, whereas every other company is disincentivized to do so.
Right.
And in Canada, we don't have Vanguard the way that the US has Vanguard because of the way Vanguard is owned in Canada. Right. They don't have the same incentives here as they do in the US.
The incentives in the US is to drive the cost per unit holder lower because it's a true mutual company.
Right. Whereas in the Vanguard Canada entity is not a true mutual company. And then all of the other financial institutions, like they're only getting into index investing now because they see the money's going there anyway. And if they don't get in, they're toast. But it took them a long time because they had obviously rather keep their active business, which is orders of magnitude more profitable.
So let's talk about this cool paper that we came across in terms of factor investing. I think we found it from actually a Rick Ferry post talking about the success of investors who invest into factor funds versus portfolios of factor funds.
It was a good study. I read it twice. When you sent it to me, I told you it wasn't that good, but I read it a second time and it's actually really good. But they looked at data from the CRISP survivorship bias-free mutual fund database for U.S. funds, and then they looked at Morningstar data for global funds from 1990 through 2015. And the way they do the comparison was actually interesting. They were using CAP-M alpha as the measure of outperformance.
Not too much jargon in there.
Well, just like risk-adjusted performance from the perspective of market risk. So it's like if two funds take the same amount of market risk, but one has better performance, the better performance is alpha. Now, that's interesting when you think about factors because you look way back to the factor research initially, and that was a problem. When you're looking at factors through the market risk lens, people were noticing that, well, small cap stocks are producing alpha. They're producing consistently higher risk-adjusted returns. Same as value stocks. So originally people are saying, well, markets are inefficient, but then the factor model just gets updated and all of a sudden markets are efficient again.
Efficiently pricing the risk.
Yeah, exactly.
And so it found that factor funds tended to outperform, so the funds themselves. However, the investors in those funds, I think this is the key, the investors in those funds underperformed. And there could be a bunch of reasons for that. I mean, obviously it's bad timing, but what is causing the bad timing? So you have a pool of investors that are overconfident in their skill.
Well, the paper says that people are, as you'd expect in general from the data that we see, people are chasing past performance. So factor strategies tend to have good past performance, and investors tend to pile money in after the past performance has happened. And one of the things the paper looked at is smart money, the ones going into the factor strategies, and they said they found that no, it's not. So you would define smart money as if the money piles in before the outperformance happens, that's smart money. But no, they found it's just people chasing past performance, which is why the investors have underperformance relative to the funds. But it's the same stuff you'd see anywhere.
But this is the beauty of having a one decision portfolio that has a variety of different factors with the constant rebalancing. I mean, look at what happened with small caps in January. Yeah. Larry Swedger did an article on that on the weekend talking about how I think the small cap value is up 20+% in the first month. You'd love to see, you need to go see the flow of funds after that happened.
One of the things in the paper that I found fascinating was they showed the data, and this is just the U.S. portion. I didn't dig into the global portion they looked at, but they said in the paper that it was similar result. Anyway, for the U.S. funds, they looked at traditional actively managed mutual funds and found that only 17% of them produced alpha after fees.
Such a small number.
Positive alpha after fees in the long run. But then they looked at factor funds and they looked at low beta, which I want to talk about in a second too, but they looked at low beta, 52% produced positive alpha, small cap funds, 53% produced alpha, value funds, 52%, momentum, 40%, which is also an interesting point because we've looked at that data in the past. Momentum looks great in the data, hard to capture, and we see that here. Funds that chase profitability, which is another known factor, 57% produce a positive alpha. Yeah, so anyway, it was interesting data. But their point was, yes, this alpha is real and it's has produced good long-term results, but investors aren't capturing it. But all the paper really says...
On their own. They can capture it in a rules-based portfolio.
Well, that's what the paper's saying.
Right.
They're saying people are chasing factors, therefore they're not actually capturing the returns. but the data is real. Like the factors are there. People just need to buy and hold, which is the same as, I mean, that's not new. I think that
it's the same as the overall market. It's another factor.
But their main point was this outperformance is real, but nobody's really getting it. Figure it out, people. The thing that I wanted to point out about low beta, I read another article from, I think CFA Institute put it out. The whole article was somewhat interesting. It was just talking about, I guess in a way similar to this, it was talking about factor returns versus smart beta returns. So factor, those are long short portfolios. Like that's how a factor is defined. The small cap factor is the return of small cap stocks minus the return of large cap stocks. So that's long small caps, short large caps. Now, most investors don't actually invest in long short portfolios. They'll just go a little bit more long small caps.
Yep.
But there's no short.
Yep. Just do the tilting.
Just the tilting, yeah. So a factor portfolio is long short. Smart beta, which is what the article I read was referring to as the long only implementation, is just long. And now the interesting thing about that for low beta is that low beta looks really good on the factor side and really bad on the implementation, the long only implementation side.
Why?
Yeah, the why is why it's so interesting. So low beta stocks, well, they're by their name, they're low beta. So they've got relatively low exposure to market risk.
So lower volatility.
But the data show, and the factor data show that they have higher risk-adjusted returns. It's like, okay, so that's interesting. But it doesn't show up. It doesn't show up as higher returns in the long-only portfolio. So the article goes on to explain that they look so good in the factor data because they're long short. So you're hedging or you're eliminating the market risk. Does that make sense?
I think so.
So in the long short portfolio, there is no market risk. You're only looking at the factor.
Right.
But then as soon as you get into long only implementation, now you're being affected by the low beta exposure, which means you've got lower expected returns because you've got lower exposure to market risk. Anyway,
bit of a head spinner.
I thought it was interesting.
Okay, let's get on to safe savings rates. I know you've taken a real interest in this. So this goes back to an article in the Journal of Financial Planning back in 2011.
Wade Pfau wrote about it first, I think.
He's the one that popularized the 4% safe withdrawal rate on retirement that so many people have heard of.
Pfau didn't pop. Pfau knocked it down. The 4% rule was, I can't remember the guy's name now. Pfau's the guy that took the 4% rule and said that it only works in the US data, but he showed globally and based on current price earnings ratios, 4% rule probably doesn't make sense. But anyway, Pfau is related to 4% rule. I can't remember the 4% rule guy's name. So what Pfau said is that a traditional financial planning, which everyone's pretty familiar with, follows kind of 4 steps, where step 1 is you've got to figure out how much you need to spend from your portfolio in retirement. So if you're going to replace 70% of your income overall, maybe 50% of that has to come from your investments.
And there's no taxes taken into account in the study, was there? It just said 50% of your income.
Yeah. You could factor taxes in by picking a different number. In his example in the article, he used 50% replacement, but yeah. So anyway, you got to figure out how much you need to spend. So say it's 50% of your working income as an example. And then you've got to decide on a withdrawal rate. So that could be the 4% rule. It could be the 3.5% rule, whatever it is. And there's tons of different data on that. So that in itself is a decision, which spending rule you're going to use. And then you've got to figure out how much you need to save to get a portfolio large enough to fund your desired portfolio expenses based on the withdrawal rate that you want to use.
And so far, this is all normal. This is
traditional financial planning.
Traditional retirement planning goes.
And then the last step 4, is figure out how much of your income you need to save to achieve that wealth accumulation goal such that you can spend whatever percent of the portfolio to fund your desired lifestyle.
Right. But the problem with this, and I get this from reading the paper, is that it decouples the savings side of the equation with the withdrawal side. That's the issue here. And those two have historical links that do matter a lot. Yeah,
that's exactly it. When you look at a single period, like if we think about the 4% rule comes from basically the worst 30-year period for a retiree in the US data. But what Pfau is saying in his paper is that if we look at that 30-year period in isolation, that's true, but the preceding 30 years, so the years that somebody would have been saving, tend to have much higher returns. Right. So if you retire right before a period that has a long period of low returns, relatively low returns, it's highly likely that the preceding 30-year period had relatively high returns.
Therefore, your savings rate could be lower.
Therefore, your savings rate could have been lower. But you end up not planning too conservatively on the savings side or too aggressively on the retirement side by decoupling the two time periods. So Pfau suggests, as opposed to that 4-step traditional financial planning process, he says, step 1, same as above, figure out how much of your income you want to replace. But then step 2, as opposed to looking at the historical data to figure out what a safe spending rate is, look at the historical data for the full period, the savings period and the withdrawal period, and figure out what historically would be the safe amount to save of your income for the entire time that you're working, such that you can fund your retirement, ignoring the value of your portfolio at retirement.
So if you're in a period of lower expected returns, that means it should allow you to have a larger withdrawal rate once you retire, because the returns would be expected to be higher later.
Correct.
If you believe in these big cycles.
Correct. Yeah, that's one of the things that was a red flag for me in the research, is that it is assuming that there are cycles. Now, there has been serial correlation in stock returns.
But is the message then not to be too excited if you happen to get a really bad time in the markets? I mean, they talked about how in 2008, imagine if you retired January 2008, and you compare that to January 2009, your portfolio is down 25 to 40%. That 4% is a massive difference.
So he says that this is one of the tragic things about traditional financial planning, is that you have two people who retire 1 year apart. One of them happens to retire with $1 million. The other one happens to retire with $600,000, and they're using the 4% spending rule. One of them is going to spend way less than the other for the rest of their retirement.
Yep. Because that 4% rule assumes that's the number when you retire. You stick to that number with inflation through your retirement. But the practical on the ground reality is that most people review these numbers every year to make sure they're on track. And we're always coaching people to make sure that their need to spend is way less than their ability to spend if possible.
Right.
And it's that discretionary cushion that.
But when you take the safe savings rate perspective, you don't care about what your portfolio is valued at. So the withdrawal rate for two people who have done a safe savings rate planning approach as opposed to a safe spending rate, their withdrawal rates could be vastly different.
Exactly.
At retirement.
Exactly.
But they don't care. They're not looking at the value of the portfolio. They're not looking at their withdrawal rate, but they are making this assumption about the cyclicality of
So how do you see
returns.
this trickling down to actual advising clients?
I mean, it could be a whole other way about thinking about all of this, because right now we do think about it from the traditional approach where we've got a wealth accumulation goal. But as soon as you implement a safe savings strategy as opposed to safe spending, it changes the whole conversation around financial planning. And I guess one of the other important pieces about this is that if you only look at the safe savings rate to achieve a wealth accumulation goal, because you can do it both ways, right? You can say, okay, if you have $1 million, you can spend 4%. But the other side of that is, what's the worst case scenario of required savings to get to $1 million? So that's still two decoupled scenarios. And in the research, Pfau showed that you would need to save in the worst case scenario to get to your desired accumulation goal. You need to save 37.7% of your income, which is crazy. Like, no one's going to do that. That's the equivalent of the 4% rule on the savings side, 37.7%. But that's still looking at the two periods in isolation, decoupled.
So we should throw this table that we have here in the show notes, because it does show you, based on different asset allocation assumptions, how many years in retirement and how many years of saving, what your savings rate should be. And there are big differences in the numbers. 30 years of savings and 30 years in retirement, the savings rate is just over 16% of your income.
That's kind of his base case.
If you have 40 years of savings, it goes down to 8 to 9%, which is kind of that 10% rule that David Chilton popularized.
And I guess one of the other big points of this is that if you happen to have a wealth accumulation far in excess of what you would need to fund your lifestyle based on a withdrawal strategy, so if we're saying it's a 4% rule, and all of a sudden you're 10 years away from when you thought you were going to retire and you have enough to fund retirement with a 4% rule, this research is saying that you should not retire at that time, because your ability to get there is probably driven by higher than expected returns, which means in the future, market returns should be lower.
That's really interesting.
Yeah. So that's one of the other big risks of traditional financial planning, is that if you end up with this big wealth accumulation because realized returns have been higher than expected, then it's not a prudent time to retire. But if you're taking the safe savings approach, you don't care about that wealth accumulation. You're just saving a fixed amount of your income.
It's interesting. We had kind of the 2 meetings last week where people knew what their lifestyle costs are, and they've been great savers, and they're halfway through their careers now. And the plan was just so easy and effortless for them because they've got low cost structures in their lifestyle, no debt. And it's like, it's absolutely going to be and we're not talking about necessarily high income people, just your average couple that has just done everything right from the beginning, maximize everything. And it's like, it's completely effortless. Whereas other people have no idea what their spending rates are in retirement. Even to get that number, how much do you need per month once you stop working? It's often a challenge.
Oh, that's a big challenge. People never know the answer to that question. Sometimes it takes people 2 years into their actual retirement to figure out if the amount that we planned for is right. Yeah, that's not an easy nut to crack.
But it's interesting. If you have your back up against the wall to save, and therefore you try to take on higher expected returns, if you get those expected returns, it means you should assume, Pfau is saying, lower drawdown on the other side.
Yeah, but instead of planning, you're almost, in the safe savings world, you're agnostic to expected returns. Like doing financial planning, saying, okay, we expect a 5% rate of return, therefore you need to save this much to get to this amount to fund your lifestyle. You don't care about that anymore. If you're talking about safe savings rate, you're saying we're not making an assumption about future returns. We're just making the assumption that the worst case 60-year historical period is sufficiently bad, I guess, to model the worst future 60-year period. And if you save based on that worst historical 60-year period, then you'll be in good shape regardless of expected returns.
So interesting.
So you're not even saying I need to save this much, or I need to get to this goal. Like people always say, what's the number?
You're focusing on the habit as opposed to the target.
Correct. And you're saying the target's meaningless. This approach is saying there should not be a wealth accumulation target.
You could have it in your scenarios, but it's not about the number. It's about the process.
And it's being strict with the process where if you do hit, because people will still have, even if you don't define one, people will still have a wealth accumulation goal.
That has enormous appeal behaviorally, because if people have this number that you have to hit, you can see people saying, yeah, we'll get to that next year. Whereas if it's a process is day in, day out, month in, month out.
Yeah, but it goes beyond that. One of the things that Pfau talks about in his article on this is that if someone is way below their intended wealth accumulation goal when they're getting to retirement, assuming that they've been saving based on the safe savings rate, if they're below what would be their wealth accumulation goal, they may get discouraged and stop saving. They may delay retirement unnecessarily, but it's just because market returns were lower than expected up until retirement, which means we have higher expected returns going forward. It completely flips financial planning on its head. Completely ignores wealth accumulation targets, completely ignores spending rates. The only thing we care about is how much you save. And we make the assumption that if you follow that, if you save whatever that number is, you'll be okay. It's worth really quick just running through if we look at the 50% replacement scenario. So we're saying that you need to replace 50% of your final salary, and say you're accumulating for 30 years. The safe savings rate is 15.64% of income for a 20-year retirement and a 40-60 asset allocation. And then if we say 30-year pre-retirement, 40-year retirement, safe savings rate goes up to 22.19%. But there's a massive impact from asset allocation too. So that was for 40-60. If you're 80-20, 80 stocks, 20 bonds, for a 30-year accumulation and a 40-year retirement, the safe savings rate drops to 16.54%. So like 6% of your income, different savings amount. Anyway, I thought this research was fascinating. And I think that we'll definitely think about getting more serious about actually using this when we're doing financial planning.
But even at the other end, you have someone that loves what they do. If you want to save for 40 years for 50% of your final salary in a 60-40 and have 20 years of retirement, it's 7.5% savings rate.
That's
it's also
true.
about knowing what makes you happy and where you want to be. If you go 80-20, it's just over 6% savings rate.
That's true. This gives a whole different way of thinking about asset allocation too, because it directly relates, how much you're saving to your asset allocation. Because now you can say, if you want to save a little bit less of I guess we kind of already knew this. If you want to save a little bit less of your income, you can take more risk. Or if you're not comfortable taking risk, it means you need to save this much more of your income.
Well, your FIRE numbers here too, right? 20 years of saving, 40 years of retirement, and you want to be conservative in a 40-60 portfolio is 47% of your salary.
That is interesting.
So we'll throw this table on the show notes.
Yeah. I think for further research on this one, just like Pfau took the original 4% rule and applied international data and applied current price earnings. So he kind of said it's not really 4%, it's probably more like 3.5 or 3%. I think there's further work to be done on this as well because Pfau used historical S&P 500 data, just U.S. stocks.
There's no MERs and there's no taxes, but it's still a good guideline. We should do more work on this.
Yeah, I think we could dig into this and do some more.
All right, that's it for this week.
Yep, that's it.